Right. So in chapter 7, we learned about three major risks that financial institutions can have, and also other risks that financial institutions need to care. And in chapter 8 and 9, we are going to talk about the measurement of the interest rate risk. So as the first part in chapter 8, we are going to learn about two different ways to tell about the interest rate risk in a financial institutions. There are two models, repricing model and the maturity model. The repricing model is a traditional model that explains about the degree of the interest rate risk. And maturity model is a substitute or the complement because there are some disadvantages or the limitations in the repricing model. And in the next chapter, chapter 9, we are going to learn about the duration model, which is the new and more applicable model that explains about the interest rate risk. So we are going to start from the traditional explanation, repricing model. So before we move on, I wanted to show this because I also want to share the common thought that interest rate risks are there. So nowadays, people seem to forget about the interest rate risk because for the last decade, the interest rate was at the minimal level and historically lower level, and therefore the investors or the financial institutions didn't care about the interest rate. However, as you can see, if you look at the history, interest rate is very important factor. So this is a historical interest rate of the treasury bill, which is the government bond of the United States. And you can see that there is a it shows the interest rate risk from 69 to 2017. So this long during this long period, actually what we recently experienced is that the interest rate was very low, and this was not the normal case. Actually, this was a very scarce opportunity to have this lowest interest rate. Actually, for the rest of this long period, interest rate was higher than approximately 3 or 4%. So, and also the interest rates vary often. So it changes over time. So therefore, we can see that interest rate, the change in the interest rate can influence the performance of the financial institutions significantly. And then, how can we assess or how can we measure the interest rate risk? One of the ways is the repricing gap. So the repricing gap here, so this is the gap, so this is the difference. And we are going to compare the size of assets and liabilities. So we are going to take the difference between assets and liabilities, and we are going to call it as a gap. But we are not going to include any kinds of assets or any kinds of liabilities. We are going to think about some assets and liabilities within a specific maturity bucket. For example, we are going to just only collect some assets and liabilities where their maturities are between 1 day and 3 months, or 3 months to 6 months. So we are going to think about the specific range of the maturity. And also, we are going to think about the rate sensitive assets and rate sensitive liabilities. When we say there are rate sensitive assets, it means there are also rate insensitive assets. So the rate sensitive assets are the assets that are affected by the change in the interest rate. So the reason that we only care about the rate sensitive assets are very straightforward. We are thinking about the change in the interest rate. So therefore, we just focus on the rate change. So therefore, we don't have to care about rate insensitive assets. And similarly, we also have rate sensitive liabilities. So this is the financial institution's current situation, and here, based on the maturity, they classified their assets and liabilities into 6 buckets. One, less than 1 day. 2, more than 1 day to 3 months. 3, 3 months to 6 months. 4, 6 months to 12 months. 5, 1 year to 5 years. 6, over 5 years. And we have assets and liabilities. And then for each bucket or each category, we are going to calculate the gap as the difference between assets and the liabilities. So the gap for the first bucket is 20 minus 30, so it will be minus 10. For the second bucket, 1 day to 3 months, assets are 30 and liabilities are 40, so the gap will be again 30 minus 40, which is minus 10. For the third bucket, assets are 70, liabilities are 85, so the gap will be 70 minus 85, so it will be 15. So similarly, we calculate the gap for each bucket. So we have 6 gaps. And then we just concentrate on a specific bucket. If the gap, the repricing gap is positive, then it means there are more rate sensitive assets than rate sensitive liabilities. And let's see what happens. So let's think about the income statement. Of a commercial bank, and there will be interest income, and there will be interest expense, and the difference between this is what we call the net interest income, or in short, NII. And we are going to forget about non-interest income or non-interest expense because we are thinking about the interest rate. And how can you calculate the interest income? We learned that this is calculated as earning assets times the interest rate. For that, And the interest expense is also calculated as interest bearing liabilities times the interest rate for that. So that will be the interest expense. And then if there is some change, so whenever I use this kind of triangle, it means it is called as delta, and the delta, this symbol represents the change. So the change in the net interest income will come from the change in the interest income or the change in the interest expense. And this will come from the change in the interest rate for the earning asset and the change in the interest rate for the interest bearing liabilities. So because of the changing interest rate, we will suffer some change in our net interest income. So this is why we want to calculate the repricing gap. So instead of caring about the total earning asset, we focus on the specific rate sensitive asset, and instead of the overall interest bearing liabilities, we want to think about the rate sensitive liabilities in the bucket. So because the interest rates are different for each maturity, we want to focus on that maturity. And then if this and this are equal, then the change in the net interest income, delta NII, should be RSA minus RSL times change in the interest rate. Because this is RSA times delta interest rate minus RSL times delta interest rate. So therefore, if they are the same, then we can say that the change in our net income will be calculated as the difference between RSA and RSL times delta R, which is the change in interest rate. And this is the repricing gap. So by measuring the repricing gap and by expecting the future change in the interest rate, we can easily calculate the expected change in the net income. So if the RSA is larger than RSL, we say that the repricing gap is positive, and then we will have the reinvestment risk. Or on the other hand, if RSA is smaller than RSL, this is negative, and then we will have the refinancing risk. Let me use an example for this. So here in the previous table, the repricing gap for the first bucket, the maturity less than 1 year, was negative 10. And therefore, if we expect that the interest rate on 1 day will rise by 1% per point, and the expected change in the net interest income is calculated as the multiplication between the gap and the changed interest rate, which is 1%. So we can get our the effect of the change in our interest rate. So this is the change in the net interest income, which is minus $100,000. So when the interest rate rises, we experience the adverse impact on our net interest income, and this is a typical refinancing risk. And this happened when there are more rate sensitive liabilities, when the repricing gap was negative. So when the repricing gap is negative, we say there are refinancing risk. Sometimes we can also think about the cumulative repricing gap. Especially, we pay special attention to the maturity less than 1 year. So if we want to think about the short-term interest rate changes, generally we think about the maturities less than 1 years. So in that case, we need to consider the 4 buckets together, because for the interest rate shorter than 1 year, we need to care about these 4 together. So in that case, we can calculate the cumulative gap. Here, the cumulative gap is the addition of these gaps. Minus 10, minus 10, so minus 20, minus 15, so we have minus 35, plus 20, so we have minus 15. So this is the cumulative 1 year gap. And if the interest rate on a year falls by 1% point, and then the change in the net interest income will be the minus 15, so which is the gap, times minus 1% point. So this is minus 0.01. So the net interest income will be, the change in the net interest income will be $150,000. So this is positive. So we are not expecting some negative shock. So this is not a concern. So here the reason that we are not worrying too much is that because we have a negative gap and we expect that the rate will fall. However, if we expect that the interest rate will rise, then we will experience some negative shock. So it depends on whether we expect a rise or the fall in the interest rate. So there can be 2 different situations. So this is the core principle in the repricing model. So there's nothing more. However, in practice, it can be more complicated, because you need to calculate, in order to use the repricing gap model, you first need to calculate the rate sensitive assets and rate sensitive liabilities. Then how can you choose appropriate assets and liabilities? In principle, you should think yourself whether these assets or liabilities are affected by the change in the interest rate. So this is an example. So there is a financial institution, and this institution has a lot of different assets and also different liabilities. So let's look at the asset side. So if we are going to think about the 1 year maturity bucket, so we are going to think about assets and liabilities with maturity less than 1 year, then what can be the rate sensitive assets? Let's look at the asset side. First, we have short-term consumer loans. So these are loans lended to individuals. and the maturity is 1 year. Obviously, we should include it because the loans have interest and the maturity is 1 year, so it is included in the bucket. On the contrary, we also have another consumer loans. However, we do not include the second one because it is long term. So we are only thinking about maturity less than 1 year. However, in the second item, the maturity is 2 years, so it is longer. So we don't have to worry for the short period of time. So we are not going to use it. We are not going to call it as rate sensitive asset. So these are excluded. Number 3, we have treasury bills. Here the treasury means the United States, the Department of the Treasury. So this treasury means this is a bond issued by the US government. And depending on their maturities, they have 3 different names. Treasury bills are bonds with the maturity less than 1 year, or short-term government bonds. Treasury notes, they are with middle maturity. So they are generally longer than treasury bills, but shorter than treasury bonds. Finally, treasury bonds, they are generally, their maturity is generally longer than 1 year. Generally, they have 10-year maturity or 20-year maturity. So these are long-term government bonds. So we have treasury bills, treasury notes, and treasury bonds. And then, which should we include and should we not? First, we should include 3 months treasury bills because the maturity is 3 months. So therefore, after 3 months, it will mature. And then we have to reinvest. We have to purchase more treasury bills. It means we are going to be affected by the future interest rate change. So therefore, within 1 year. So therefore, we should include it. Number 4, 6-month treasury notes. For the same reason, we should include it. After 6 months, it will mature and we are going to be affected by the interest rate in the 6 months later. So we are going to include 6 months treasury notes as the rate sensitive asset. Number 5, 3-year treasury bonds. We do not include it. This has maturity of 3 years. So for the upcoming 3 years, we don't have to worry because it will provide us the same interest for the 3 years. So we are not going to be affected by the changing interest rate due to this. So we are going to exclude number 5. So at this moment, we excluded number 2 and we excluded number 5. And let's move on. Number 6, 10-year fixed rate mortgages. Mortgages are loans provided to the house purchasers, and they guarantee that they are going to repay using their houses. So here the maturity is 10 years, and as you can guess, this is longer than 1 year, so we are not going to include number 6 in our calculation. These are not rate sensitive assets. And one can argue the similar logic to number 7. Number 7 is 30-year floating rate mortgages. Then you are wrong because we should distinguish between fixed rate and the floating rate. So when you borrow from the bank, you have two choices. First, you can borrow at a fixed rate. By borrowing at a fixed rate, it means you are going to apply to the same interest rate for the rest of your lives, for the rest of your borrowing. So after 1 year, you need to pay the same interest. After 2 years, you pay the same interest rate. After 3 years, you pay the same interest for these mortgages, regardless of the economic situation. However, when you borrow at a floating rate, it changes. It depends on the market situations. Generally, the bank offers the floating rate like this. Plus So this is a typical example of the floating rate in Korea. And this call rate is the Bank of Korea's interest rate. And this borrower will pay 3% additional interest given the Bank of Korea's interest rate. So when the Bank of Korea raises its interest rate this month, then from the next month, I need to pay more interest. If the Bank of Korea lowers its interest rate in the next month, then I'm going to pay a smaller amount of interest from the month after the next month. So in the floating rate system, the interest changes over time depending on the central bank's monetary policy. So therefore, here, the item 7, 30-year floating rate mortgages, although it has maturity of 30 years, so the maturity is longer than 1 year, it also says this is a floating rate and the rate will be adjusted for every 9 months. So after 9 months, the rate will be changed. Then I will be affected by the interest rate risk. When the interest rate changes, the interest that I receive changes. So therefore, contrary to the common belief, the item number 7 should be included as the rate sensitive asset. So as a result, we have 4 rate sensitive assets. First, we have short-term consumer loans. Second, 3 months treasury bills. Third, 6 months treasury notes. And finally, 30-year floating rate mortgages. And therefore, our rate sensitive asset for 1 year maturity will be 155. And let's look at the liability side. Item number 1, equity capital. These are not liabilities, so we exclude it. These are equity capital, so we don't care about it. Let's start from the second one. Demand deposits. In the United States, until 2013, it was forbidden for a bank to give interest for the demand deposits. So essentially, the interest rate for the demand deposits were 0. It means demand deposits are not rate sensitive liabilities. It is not affected by the change in the interest rate. In Korea, generally, the interest rate for the demand deposits is 0.1% per year. So this is very, very small. So in Korea also, we don't care, we don't consider the demand deposits as the rate sensitive liabilities. So naturally, we exclude demand deposits from our calculation. Number 3 item, passbook savings. This is difficult because it does not exist in Korea. So this is a special kind of instrument available in the United States in the past. So here the passbook is the bank book. So you have a traditional bank book, I'm not sure whether you had it or not, because nowadays we just use our mobile app. We don't go to bank anymore. So I'm not sure whether you had a chance to have your own passbook. But in the past, we need to record our transactions using our bank book from the bank. And this is a financial instrument using the bank book, recording how much money that I saved in the bank, So in United States, typically the passbook savings, the interest rate is also quite low, and it is not changing over time. So therefore, the textbook says you should not include the passbook savings as rate-sensitive liabilities. But again, nowadays there are no more passbook savings frequently used, so actually we don't have to care about it that much. So we are just going to ignore it. And let's move on to number 4, 3 months CD. So here CD is certificate of deposits. So this is also a kind of deposit. However, the difference between the usual deposits we have and the CD is that you cannot change the holder's name for typical deposits. However, for the CDs, you can change the name of the holder. You can trade it. You can give it to your friend, and then still the bank has the responsibility to give the money to your friend. So it does not specify the person who having this certificate of deposits. This is only a proof or a document that specifies the total amount of money that is stored in a bank. So whenever you have this certificate of deposits without any approval or without any other kind of some documentary proof, you can just get the money out of your certificate of deposits account. And these are the maturity of these CDs are 3 months. It is less than 1 year, so it is rate sensitive. After 3 months, now it will be matured, and therefore, if the financial institutions want to maintain it, then it needs to offer new interest rate to the customers. So therefore, it will be affected by the future change in the interest rate. So we should consider it as rate-sensitive liabilities. Bankers' acceptances and commercial papers, these are similar. So these are borrowings of the financial institutions from the other companies or the other investors. What you need to focus is that both of them has maturity less than 1 year. So you should consider these two as rate-sensitive liabilities. 1 year time deposits, they should be included because the maturity is 1 year. So in a year, you will need to offer new interest rate, so therefore it will be affected. However, although it is also the time deposit, the item number 8 should not be included because the maturity is 2 years, so therefore during the next 1 year nothing happens. So you can exclude it from your calculation. So as a result, the rate sensitive liabilities can be calculated as the sum of 3 months certificate of deposits, 3 months bankers acceptances, 6 months commercial paper, and 1 year time deposits. And the 1 year rate sensitive liabilities will be 140. So as you can see, the calculation of rate sensitive assets and the rate sensitive liabilities, you need to know what these items are, and also you need to check whether the maturity is longer or shorter than your bucket. And then you can get the exact amount of rate sensitive liabilities and assets. So here the 1 year cumulative gap is the rate sensitive assets of 155 minus rate sensitive liabilities of 140. So this is 15.